Thank you for joining us for session 3 of Investing for Income Summit. Tonight marks the conclusion of our journey in which we're looking at innovative strategies for generating reliable income and preserving wealth in today's evolving financial landscape. I am Bob Simpson, Vice President Portfolio Strategy at Wealth Stewards and co-founder of privatedebtequity.ca, a platform dedicated to private lending and equity strategies tailored to Canadian investors seeking income and capital preservation. I also host the podcast My Private Network, available on Spotify and Apple, where we dive deeply into private investing. Tonight's session will be recorded and it will be made available as a podcast episode. In session 1, we introduced private lending and equity investing fundamentals with insights from some very interesting leading experts. Session 2 focused on optimizing income strategies. Tonight, we're going to continue with some thought-provoking discussions from 4 distinguished panelists. We're going to talk about music royalties, and we have Michael Baker joining us from ICM Asset Management. Following that will be purpose-built student accommodation with Aly Damji from Forum Asset Management. Batting number 3, tax-efficient investment strategies, Mustafa Bukhari from Skyline Wealth Management. And batting cleanup tonight, integrated portfolio design, where we're really going to try to pull together everything that we've learned from the 11 previous sessions and look at how you build that into a portfolio that generates income and protects your capital. These discussions highlight unique opportunities to enhance portfolio income potential while managing risk, crucial for high net worth families aiming to secure their financial futures. Following the panel discussion, we're going to conclude, as we've done in the previous, with a Q&A session. There is a Q&A button on the Zoom. I think I've said go to meeting each time on the Zoom control panel. So you can submit your questions there. We'll watch for them, total them up, and our guests will be hanging around to answer any questions that you might have. So kicking things off, our first speaker this evening is Michael Baker, Principal and Director of Sales at ICM Asset Management, a leading alternative investment management firm. Michael is our go-to expert for understanding and staying on top of investments in a relatively new, exciting asset class, music royalties. Hey, Mike, how you doing?
Well, thanks for having me.
Yeah, joining us from the city that it's hard to guess the weather, isn't it? What do you got today?
Yeah, we've got minus 15 and about a foot of snow, so kind of right on brand.
Yep, and it'll all melt tomorrow and be back in a couple of weeks, right?
You got it.
You got it. Now, music royalties, for those of you who are unfamiliar, are payments made to rights holders such as songwriters, composers, recording artists, or music publishers. Wherever the music is used, performed, reproduced, or distributed, these people get paid. These royalties are a vital source of income for those involved in the creation of ownership of music, but it's also available now to investors. So, Mike, kicking things off, what has ICM done to create an investment vehicle for investors seeking reliable, low-risk monthly income?
Sure, and maybe for the benefit of your listeners and viewers, I'll lay a little bit of a foundation for the asset class, and it's a pretty simple one, and it's that music has to be licensed. So regardless whether you're hearing things through a traditional streaming service platform like an Apple, Amazon, Spotify, or you're listening through, you're hearing music through video games, TV shows, social media, radio, live performance, and everything in between. If you're hearing music, whoever owns that underlying intellectual property is being paid a royalty for its use. So effectively, the ecosystem is in place and has created this source where anybody who's owns these intellectual property, typically artists and creators, producers of alike, own their work. And really what that means is that they own this portfolio of work that generates them a monthly income when their titles are being used. So our business model of the fund platform is relatively simple. We effectively set up a perpetuity fund structure to acquire these rights. And really all we're doing is that we're going out and we're paying a multiple on the trailing cash flow of these catalogs. And the term catalog effectively means a collection of underlying songs. And we pay a multiple to acquire them, and then we just hold them forever. So the intent is that investors have access to this evergreen vehicle that is in perpetuity a source of yield that has no correlation to other components of their portfolio construction.
Yeah, I find it interesting that your team's based in Calgary. It's, really an energy town. What, what can you say? You decide this is a good idea. We're going to get into music royalties. What have you done to build expertise in this niche asset class, Mike?
Sure. So this is a platform that we started looking at back in 2019, and we ultimately launched the fund back in 2020. And it was kind of on the backs of this being a pretty institutionalized asset class. If you were to dive deep into many of the major, in fact, almost all of the major private equity, private credit players of the world, sovereign wealth funds, pension plans of the like, anybody that has kind of long-term income generation goals, this is an asset class that's been utilized for years, but just didn't have a kind of a dedicated open-ended evergreen vehicle available in the Canadian market. So we started looking at it, like I said, back in 2019, ultimately launched in 2020, and it's been pretty successful since then. So, outside of building a advisory team, which we have in place, which are people that are connected to the entertainment and music industry, so everybody from, talent managers to legal advisors to, producers and songwriters of the like, those component parts of our team are obviously very important to help kind of source and acquire these assets. But let's not lose sight of the fact that, when you boil this down to a financial asset point of view, these are very simple assets to understand, very simple assets to underwrite, and very simple assets to own. So we've been pretty optimistic about where this platform is going to be taking us in the years ahead.
Yeah, so you've used the word simple a number of times already. It's
Yeah,
a simple game. This is a simple
it's
game.
it's simple if you understand the assets. So there's, I kind of joke with our clients all the time that, the difficult part here is understanding copyright law, understanding how the industry component payment flows work, how to administer royalty rights, how to collect, how to track and report these assets.
Mm-hmm.
So that's the challenging part. But again, from a financial asset point of view, these are ridiculously simple assets. You effectively own a perpetuity asset where your cash flow is equal to your revenue due to the fact that there's no incremental capital cost needs on the assets. And these are perpetuity assets in the sense that copyright law dictates that income collection from the underlying use of these songs that we own last for the life of the artist plus 70 years. So effectively, when the last remaining band member dies of somebody who's created the work, a 70-year clock starts. And after that, it becomes public domain. But for all intents and purposes, we're talking about a perpetuity income stream. So when you're looking at this, you kind of facetiously said, how do a bunch of guys from Calgary end up in this space? Well, the answer is that these are nearly perfect financial assets. So from an underwriting and acquisition standpoint, it's not all that complicated of a business model.
Yeah, so you were saying that people have been buying and selling music royalties for years. There just hasn't been a natural place for investors, like the people who are on the call tonight, to invest in music royalties. We know that it's simple. If you want to own stocks, you can buy Apple or any other stock that's out there. You could buy a mutual fund that invests in it. So investors now have the ability, but they can also go out and buy the music directly. If they find a title and available, they can buy it themselves, right? But it's not easy, and kind of the bid to ask spreads are pretty wide from what I've seen.
Yeah, so there have been platforms that have been set up that will allow, very small kind of, whatever you want to call it, micro transactions to happen in the ecosystem where, Bob Simpson with $8,000 can go out and buy one singular song.
Mhm.
Mind you, if you're buying it for $8,000, likely not all
Not
that
much.
popular of a song,
Yeah.
but
Yeah.
that's possible.
Mhm.
But really the key to why you'd want to invest in this asset class is due to the stability of the income. And
Mhm.
in part, the stability comes from owning a very large portfolio. So, I won't dive into kind of every acquisition we've done, but we've done deals and acquired assets in basically every major genre you can think of, across every major kind of time period in music that you can think of. But the commonality between all the deals that we've done is that they produce a stable income. We
Yep.
typically like to buy them when they're at least 5 years old, and the
Mhm.
artists themselves have to be reasonably iconic, meaning that their works will be used or played in the ecosystem not only tomorrow but 10, 20, 30 years from now. And that's really important. So, when you're talking about kind of the reason why you'd want to own this asset class, I mentioned earlier that you're generating an income stream that has no correlation to other components of portfolio construction, but
Mhm.
that stability really comes from owning a very large number of these pieces at the same time, right? So we've acquired a portfolio of almost 5,000 pieces of intellectual property across dozens and dozens and dozens of artists. And that's
Mhm.
by design, is that you kind of want to just collect, beta in the asset class, if that makes sense.
Yep. So you can, the big name in town last couple of weeks has been Taylor Swift. So you could actually buy the rights to Taylor Swift music, but not necessarily from her.
Yeah, that's right. Like, so by definition, music IP is fractionalized from the get-go. So, Bob, if you were the lead singer of a band, you would likely own a large piece of the underlying intellectual property associated with the works that you create,
Mhm.
but you wouldn't own all of it, right? So your guitarist would own some, your drummer would own some, maybe your songwriters would own some, maybe your tour manager would own some, your label might own some. So by definition, music is already fractionalized. So
Mhm.
when we're going out and doing these acquisitions, in many cases we are buying them from the artist directly, but in other many cases we're buying them from other, call it industry components, which could be band members, producers, labels, and everything in
Mhm.
between.
Yep. Yeah. So now let's try to translate this into an investment. So you've got a broadly diversified portfolio, large number of intellectual properties that are in your portfolio. What have you been able to do with that in talking about returns for investors? What kind of returns have investors who've been with you for a long time or even over the last year? What kind of returns have you been able to generate for them?
Sure. So we use little to no leverage in our platform. So when you don't use a ton of leverage, the return band in this asset class is relatively narrow. So you should think about it almost like a multiple on trailing cash flow is kind of the easiest way to think about it. So Bob, if you were a kind of an A-list artist, you produced a catalog, or I should say you produce music and it's a component piece of your catalog. And let's say that catalog of yours is spitting out $1 million a year in annual free cash flow.
Hmm.
Our business model is that we come in and we say, okay, we're willing to pay you 10 times trailing cash flow to buy your portfolio. So now instead of you owning the underlying IP, we do. And that exercise basically is just re-registering the owner. And from there, because of the fact that we just own it forever, the return profile of the asset is going to be largely dictated based on the multiple that we've paid to acquire it to begin with. So because we've acquired our portfolio at, rough numbers here, we've acquired it at about 11 times trailing cash flow, and our average payback on the asset is about 9.5 years. And that's due to the
Hmm.
fact that the cash flows slightly grow over time. But
Hmm.
how you should think of that from a yield perspective is that, net to the client, without the use of leverage, this is an asset class that can reasonably support kind of a high single digit yield and a low double digit total return with not a whole lot of variance in between.
Yeah, so sort of 9 to 12 is in English terms is what you're talking about, somewhere in there.
Sure.
Yeah, so it has done that since day one.
That's right.
Yeah, it's
Yeah.
been so this is a really consistent return, and the return profile. should be consistent. And, now we have to look at risk. What are the major risks of somebody investing in this? Because basically you've just got music that's producing royalties for the investors. That's pretty simple. What could go wrong?
So maybe the first thing I would point out is kind of diversification risk, right? If you were to go out and try to buy one singular song or one singular artist, you kind of have quote unquote diversification risk where anything could slightly fall out of favor, which increases your payback time. So again, to my point earlier, by design, you don't really want to just own one small piece of IP. So certainly there's risk in diversification, and as we continue to grow the portfolio, the goal is that diversification just continues to increase and increase and increase because we're not transacting and selling the underlying assets.
Yep.
The other piece here would be leverage, right? I mean, this is like I said earlier, a highly institutionalized asset class, and it's not uncommon that large institutional players are applying a bunch of leverage to these assets, meaning they're buying them with some debt components. And that will obviously, increase the variance of return profile. But again, if you do it with very little leverage and you pay strong attention to the multiple that you're paying on the front end on the way in, there isn't a ton of quote unquote risk. But the risk largely comes from the industry itself. So the way that the asset class works is that, kind of a dumbed down way to think about it would be that for every dollar that's generated in the music ecosystem, whether that be through streaming, subscription revenue, ad supported revenue, whatever it may be, about 30% of it is kept at the platform level, meaning the Spotifys and the Apples of the world, and about 70% flows down to the underlying rights holders. So we've been beneficiaries of pricing power by these platforms, meaning, Spotify increases prices by 10%. Our underlying cash flows from Spotify increase 10%. It's simple arithmetic. But
yeah,
if you took a view that pricing power could move the other way, you could call that a risk. But again, given what we've seen in the past, I would say that would be highly unlikely.
Yep. So just wrapping it up so we can stay on track.
Sure.
We should expect pretty consistent returns somewhere in the 9 to 12% range over the next 2 to 3 years is what you're looking at. And as long as Spotify doesn't shut down and people stop listening to music, it's reasonably predictable.
That's right. Yeah. And music as an investable asset class might be quote unquote new, but I mean, music is a highly, highly established industry. I mean, music's been played for hundreds and hundreds and hundreds of years. So I don't think music is going anywhere, but yeah, we're pretty excited.
And you have some rights to Christmas music too, right?
We have small Christmas music exposure. Not enough to move the needle, but sure.
Yeah, it's still there. Okay. Thanks, Mike. We'll catch you at question time.
Thank you.
Next up is Aly Damji from Forum Asset Management. Aly is going to be sharing with us insights about purpose-built student accommodation, kind of a fancy term for places for students to live, which is, it's pretty unique. It is a growing area in the real estate investing area. And I think Elliot might even have some brand new news hot off the wire for us today. Aly is managing partner of real estate at Forum, where he leads the firm's real estate business with a focus on originating new opportunities and investment oversight. Since joining the firm in 2020, he has driven substantial growth, including a $1.5 billion development pipeline encompassing over 3,000 units of student housing and micro units. Previously, he was with Hallmark, where he grew assets under management nearly 15-fold to just under $1 billion. Before that, he was director of investments at Westmont Hospitality Group, managing acquisitions across North America and overseeing some of their trophy hotel assets. With over $4 billion in principal assets, $500 million in debt financing, and 300 leases secured, Aly has a deep understanding in urban development, asset management, and value investments. He holds an MBA in real estate and bachelor's degree in accounting and finance from York University. Aly, thanks for joining us. And hopefully I didn't stumble on your on your intro there. How you doing?
Thanks, Bob. And no, you did not stumble, and those numbers are, much larger now with this new announcement that I'll get into with the folks listening in today.
Yeah. Okay. So let's just talk student housing
Hmm.
here. Why is purpose-built student accommodation such an attractive investment for people who are they've joined us tonight because they're looking for capital preservation and sustainable income streams? Why is this something that people should be looking at?
Well, at Forum, we have high conviction in the long-term strength of the Canadian housing market. So, firstly, and notwithstanding recent headlines regarding short-term policy decisions on limiting immigration to Canada, long-term, our country needs immigration, Bob. We have a
Mhm.
declining fertility rate, an aging population, and growing public debt. Secondly, barriers to entry are high to build housing. We've seen stats thrown around 3.5 to 5 million homes to restore affordability by 2030. Yet development charges in Toronto have increased just under 1,000% since 2010. And in Vancouver, government fees account for over $300,000 per housing unit. This is further exacerbated by shortfall in laborers and trades that we've heard of as well. Thirdly, and bringing it back to student housing, majority of the universities in Canada are facing significant fiscal pressures brought on by tuition freezes on domestic students. I know that very well because I also sit on the board of governors for OCAD University and OCAD or University in Toronto, and they're facing pressures to hold tuitions, yet costs continue to increase. The ability for universities to construct student housing in a timely way without private sector support is pretty difficult. Permanent residency via the student visa route is also something Canada will continue to endorse, given the access to a highly educated labor pool. And while in Canada, student housing is fairly early innings, in other mature English-speaking countries, student housing is a real investable asset class. Our Maple 8, our big pension funds, and some of our largest homegrown investment companies, such as Brookfield, invest in student housing across the world. By way of comparison, in Canada, we have 10 student housing beds for every 100 students. But in the US, it's 27, and in the UK, it's 16. Off-campus housing, not really a big thing here in Canada. We're at about 30%, yet in the UK, US, and Australia, it's about 60% to about 70%. And based on data that we have from global researchers on student housing, there's about a 400,000 bed shortfall of student housing in the country, and only 17,000 beds nationally under development. And
Mhm.
so this creates, what we think a great avenue for investment. And it's, further hit home by the fact that in our country, in many markets, you have rent control risk. With student housing, because it creates natural turnover, it's a transitional housing type where
Mhm.
students move, pretty much every year. They move from one unit to another type, or at least every 4 years they're moving out because they're graduating from school. You can mark rents to market a lot quicker than you can in a traditional apartment where Mrs. Jones might live in there for 20 years and you can only
Mhm.
increase rents at inflation. So that
Yeah.
gave us conviction to recently make an announcement where we're acquiring Alinvest Student Housing REIT. It's a $1.7 billion transaction. It'll make, together with our fund, the Forum Real Estate Income and Impact Fund, a $2.4 billion REIT, the largest owner of student housing across Canada. And together with our now much larger development pipeline, which has grown since I gave you that bio from 1.5 billion to 3 billion, not only the largest ownership, but also the largest pipeline where we can continue to build and add new product in constrained markets across the country.
Yeah. No, it's cool. That's an exciting announcement for you. It's a little bit of growth in a day, huh?
Yeah, that's
Yeah.
right.
Okay, so you're a York U grad, which I think that's a pretty good tie into this, but walk us through what Forum's done at York U.
Yeah, absolutely. Happy to. So back in 2010, York University came out with a RFP, so a request for proposals to find a private sector development partner to build on-campus student housing at York University. York University is pretty unique. If for any listeners, tuning in from Toronto, you'll know that York University, the Keele campus, is surrounded by a neighborhood that has pretty high crime. It's a low income neighborhood, and so the location premium is quite significant. To deliver housing on campus that's very secure. So that housing opportunity we were granted back in 2010. We have delivered 2 phases at York University in our project called the Quad. We have 1,500 beds of student housing on campus, and we're about to break ground on a third phase, our Quad Phase 3 project, which will add another 800 beds. The strength of that product is really, really high. During COVID, when students weren't in class, they were learning virtually. Even then, we had economic occupancy close to 100% at those properties because of how high in demand they are, given the offering, which is on campus around a neighborhood that is, less secure than you would find, say, for University of Toronto students or Toronto Metropolitan University students.
Yeah. So for any of us baby boomers who back in the 70s or early 80s were we'd live in the scuzziest place we could find, just because that was what we did. Big difference between that. I've had a tour of the Quad, and I was like crazy impressed that, if I wanted to get in shape, you've got a gym the size of a football field that you can work out in, and the units are pretty beautiful, aren't they?
Yeah, they're fully self-contained, high degree of security, fully amenitized. We would consider the quads the preeminent student housing projects across Canada. And what the quads represent are really the opportunity for an investment in our fund that creates new assets. So our fund, the Forum Real Estate Income and Impact Fund, it doesn't take development risk. It only owns stable assets generating long-term cash flow. We have a very vibrant development business where we build this new product, and when those new assets are complete, then they are brought into the fund. So unit holders of the fund do not have to take development risk, which includes potential construction cost overruns, time delays because zoning and entitlement issues that are fraught across the country.
Yeah.
So worthwhile point to mention.
Yeah. So we're here talking investors who have invested with Forum since inception. How have they performed, and what's the future look like?
So we launched the Forum Real Estate Income and Impact Fund at about 200 million of assets back in December 2021. Since inception, we've delivered a return of about 11%, which is on the upper end of our target range. We look at our product as a true core plus vehicle delivering stable returns, and have always targeted a return of 8 to 12% net. So we have performed on the upper end of that. And that has been achieved, Bob, by actually increasing cap rates since inception. Many managers in the private real estate space have received criticism that as interest rates have risen, they have not increased cap rates in lockstep. We certainly have, and how we've been able to deliver our strong returns has been through very strong rent growth because of our focus on this transitional housing type, where you're able to market rents, very frequently. And certainly over the past number of years, we've seen significant rent growth across the country, given the lack of supply of housing overall.
Yeah. So you've had some headwinds, and you've done high end of your predicted range, is what you're saying.
That's right, Bob.
Yeah, no, it's great. So take a look next 2 to 3 years. What do you see for student accommodation?
Well, Well, we think with this portfolio acquisition, which is set to close at the end of 2024, we see a long-term opportunity for continued growth. Firstly, the portfolio will be diversified across the country. Currently we're at 14 properties. With the Aly Invest acquisition, we're going to have 31 properties from coast to coast, from Halifax to Vancouver. That's going to give us a tremendous amount of operating scale where we're going to be able to increase income through cost efficiencies and continued rent growth. Because what we've noted in the transaction of the Aly Invest portfolio is a significant gap to market in their rents, meaning their rents in place are about 20% lower than what can be achieved on the open market. And I have a team that we built up here at Forum who are operators who are very focused on extracting that growth. So I would say that's point number one. Point number two is our development pipeline, which now exceeds $3 billion, is set to deliver new housing over the next 5 years that the fund will have the right to acquire. That's what's really telling about that portfolio is it's concentrated in really high barrier to entry markets, including Toronto and Vancouver, where we have a lot of our development products. As those assets are added into the portfolio, they actually reduce the age of the portfolio and increase the return of capital on our dividends, which is a really important distinction because our dividends and distributions that we pay, which we target about 4 to 5% a year, are effectively tax-free. Their pre-tax equivalent would be in the 8 to 9% range. And because we're adding new assets that have growing depreciation and capital cost allowance pools, we have the ability to continue to deliver return of capital distributions as we continue to add these new assets.
Right. So what you're saying is investors have been getting about 11%, but they haven't had to pay tax on that. But there will be something. And just so that I don't cut the grass of our next panelist, I'm gonna let you step aside there and bring on our next speaker. So, we're winding down, and thank you, Aly. Thanks for joining us tonight. Sorry to not say that. As we wind down 3 nights of the Investing for Income Summit, it's time to shift gears and look at something a little different, and that is tax strategies. And Aly has segued us right into that really well. This is especially timely because it's the end of the year. It's the time you're going to talk to your CPAs and CRA, just trying to figure out how do I keep some money in my own pocket instead of handing it over to CRA. So our next panelist is Mustafa Bukhari. He's the national team lead at Skyline Wealth Management, where he oversees the sales team and drives new business development, expanding Skyline's investor base across Canada. With over 12 years of experience in financial services, he holds a chartered investment management designation, and he's worked for the banks, he's worked for the online brokerages and the wealth management firms. In October of 2024, he was recognized, and this is interesting because I think we've had 3 or 4 people who have been recognized on the top 40 under 40 rising star list over the last 3 nights, which highlights his contributions to the financial services industry. He earned a bachelor's degree from the University of Western Ontario, so I hold him in great regard. Welcome, Mustafa. Thanks for joining us.
Thank you, Bob, and thank you for the introduction and sort of a great segue into what we're going to be chatting about. Good evening, everyone. I just before we sort of jump into the tax strategy side of things, I just wanted to give a quick background on Skyline. Skyline Wealth Management. We manage over $9 billion in assets with over $4 billion in investor equity across our 4 pure play mandates in multi-residential, industrial warehousing, essential service retail, and renewable infrastructure via our exempt market and broker-dealer channels.
Yeah, you're a firm that's a little different than in that most of the investors that you've been working with over the years have come to you directly, as opposed to through the normal channels of through advisors like firms like ours. So, it's great to have a firm like yours on our platform. So let's start by yeah. So you've discussed your platform, but one of the ones that we've looked at recently is your clean energy fund, which we're excited. It's something we're going to be adding to our portfolio. Not so much on the income side because it doesn't pay regular distributions, but more on the equity side. Yeah, just tell us a little bit more about what you're doing over at Skyline.
Yeah, absolutely. Our clean energy fund, we launched it in 2018. It is an equity growth investment that focuses on investing in renewable and clean energy production through our solar assets and biogas plants. However, the overall philosophy for Skyline as a real estate asset manager is to really invest in hard assets that cash flow. And so the revenue model is both predictable and diversified. We have provincial government contracts in place for the electricity that we generate into the grid from our solar and biogas plants. We collect tipping fees from municipalities for taking their green bin waste into our plants, where we then produce renewable natural gas. This entire process creates a byproduct, digestate, that we then resell as organic fertilizer to the farmers, which sort of creates that closed loop cycle where the farmers are growing their crops for food and consumption. We then collect and turn that waste into energy. And since we own the environmental attributes on the renewable natural gas, that helps us to generate carbon credits, which we can then resell on the open market.
Yeah, no, that's cool. So we've had a number of guests before yourself, and everybody's talking about their own products. You suggested let's talk tax, right? Because tax, especially in the private area, there's some major advantages of it, and it's tax efficient income is critical for high net worth investors. So, Aly talked about return of capital and how it works. Maybe just dive a little more deeply into ROC. It's called ROC, return of capital, right? Tell us a bit more about that.
Absolutely, absolutely. And the funny thing about return of capital, oftentimes I find people think that it's like receiving your own money back.
Mhm.
Essentially because they're not paying taxes on it, so they just assume it's essentially their own money. And while there may be some truth to that, the way I think of return of capital, I mean, first and foremost, it's a form of distribution. And so the best way to conceptualize it is that it is that unrealized, because you haven't sold anything yet. It's deferred because you haven't paid any taxes on it yet. Capital gain. Because when you do sell the investment, you will be left with a capital gain. Essentially, receiving return of capital as a form of distribution to your bank account will result in a reduction of your book value, right? So you'll see, your adjusted cost base go down in value, so that
Yep.
when you do sell the investment, assuming the investment, stays the same or grows in value, there will be that capital gain to pay. And so, here at Skyline, we issue that a T3 slip. Next or in the new year, shortly in the new year, investors will receive the T3 slips for their distributions, and they'll notice, where does ROC show, where does return of capital show up on that slip? Well, it shows up on box 42, and oftentimes they'll notice CRA says, well, you can file it or you can track it yourself, but essentially not paying tax on that distribution in that current year. And so, when you think about, those investors out there that are receiving their OAS pension and they're sort of, worried about a clawback, based on, the income that their investment portfolio would generate, well, it's definitely those investors that would want to consider investments that generate a return of capital, so that they can essentially construct their own pension portfolio and have, the best of both worlds.
Yeah. So return of capital is sort of like having additional TFSA room, isn't it?
Absolutely.
Yeah. Yeah. So, I kind of look at it that if you're a long-term investor, you could buy this, you could take the cash flow off it. At the end, there's going to be a tax bill. But if that ended up being an asset that was being dealt with in your estate, somebody else gets to pay the tax. And you've kind of avoided it all along, right? Is that
Well, that's right, because you get to essentially control the timing of it, because you can decide, when am I going to sell it, and then when am I going to realize the gain.
yeah.
And if it's held in my personal non-reg account, then depending on if it's in a year where I'm not going to be in a high tax bracket, maybe those are the years where I may want to sell it, and sort of maybe then move it into a TFSA account. But it's not only beneficial for investors in a non-registered account. It's also very beneficial for investors inside of a corporate account. For two main reasons. One being, the tax deferral opportunities that you have inside of corp accounts, but also understanding the way passive income and active income is treated inside of a corporate account. Generally, if I'm investing in my corp account, it's passive income, which is taxed at a higher rate. However, if I have a capital gain, well, the non-taxable portion of that gain, I can move into what they call the CDA, the capital dividend account. And once it's in a capital dividend account, I can then distribute those proceeds to the shareholders tax-free. And so now you can really start to think about other estate planning strategy. If you want to pass on wealth to your kids and you're setting up accounts, there's just a whole lot that you can do. And so what I say is, speak with your accountant, talk about the benefits of return of capital, and talk about the benefits of investing it, be it in an individual or a corporate account, depending on your personal circumstances.
Yeah, so that relates to capital cost allowance, right? No, I'm not an accountant, so just explain a little bit more as to how that
Yeah,
works.
absolutely. So capital cost allowance, and Ali sort of alluded to this as well. Is going back to return of capital, well, how does return of capital get generated? Well, really, it's done at the asset manager level. And so if I'm an asset manager and I'm buying real estate, well, I have a capital cost allowance pool, and it is an accounting function, and I'm able to essentially depreciate the assets, and then so that the earned income from the portfolio, when it's passed through to the end investor, it's passed through as return of capital. And so it's really interesting because of that accounting function that the end investor is not having to pay taxes in that given tax year. Again, on a tax deferral basis, they'll pay capital gains upon disposition. And then, in things to note of, okay, well, can a capital cost allowance pool, can that run out at the asset manager level? Absolutely. So, we need to understand, well, what are some of the things that increase that capital cost allowance pool? Well, it's new acquisitions. So new acquisitions will increase the CCA pool. Also, capital expenditure will also increase that CCA pool. So things to sort of think about is what's happening at the asset manager level, to better understand what's going to happen at the individual level.
Yeah, but you kind of have for a growing firm that you're refreshing that pool all the time.
Oh, yes, absolutely.
Yeah, yeah. So kind of final point we'll talk about is most of us are familiar with asset allocation strategies. And one of the things that you wanted to talk about tonight was asset location strategies.
Yes, absolutely. And so asset allocation, right? How are we allocating to equities, fixed income, alternative investments? And when we think of asset location strategies, what we're really trying to determine is, okay, we've identified the types of investments. Well, what account type should I hold these investments in? And I think that's very, very crucial to your overall tax planning strategies, because if I do have an investment that generates return of capital, let's say I'm investing in the apartment REIT. Well, I know the apartment REIT at the asset manager level does about 70, 80 million in capital expenditure every single year, thereby growing their capital cost allowance pool, thereby theoretically creating almost an unlimited CCA pool. So knowing that the distributions are going to be tax efficient via return of capital, well, I'm going to want to hold those investments inside of my non-registered account or my corporate account, again, because of the benefits of, deferring my taxes, or the CDA account inside of a corp account. And I want to hold then my interest-bearing investments be it a GIC or any fixed income type investments, inside of a registered account. Because we know when I have an RSP converting into a RIF and taking the income out, well, I'm taxed as income. So it really didn't matter how tax efficient, the actual investment instrument was inside of the account. When I take it out, it is taxed as income. It was a great account type to hold to defer my taxes. But when it comes down to, well, what type of income is this investment going to generate? I need to understand the classification. Is it interest? Is it ROC? Is it dividends, foreign dividends, eligible dividends or non-eligible dividends? These are the things that I want to start to consider to help determine the asset location strategy within my portfolio.
Right. Thank you. Thanks for sharing that with us and opening our eyes to some interesting tax savings opportunities. Appreciate you coming out tonight.
My pleasure.
And
Thank you.
hang around for a few minutes and not too long before we get to Q&A. Again, if you do have questions, please just use your control panel and type your question in, and we'll be glad to address it after our next panelist, who is Paul Tyers. So as we wrap up 3 nights of the Investing for Income Summit, we're going to shift gears slightly to our, just like we did with Mustafa there, we're going to look at something different, and we're going to look at, now here's what I find all the time. I go to a lot of these presentations that are put on by ICM or Forum or Skyline. A lot of times I walk away thinking, now that was really interesting information. Now, how do I use that in my portfolio? So, let's take a look at that. Let's take a look at, both, just how do you use these things and how do we stay tax efficient so that we're keeping money away from the tax man. So Wealth Stewards specializes in integrated financial planning and wealth management for families and business owners. Include things like financial planning, investment management, estate planning, tax planning, and risk management. One of the things that Paul and I like to say is a lot of firms promise financial planning, but they don't actually deliver. Whereas at Wealth Stewards, we work with investors to try to pull all the pieces together so that we get the best result for you. The firm operates with fiduciary responsibility, prioritizing client interests and leveraging a multidisciplinary team of accountants, lawyers, financial plannings, portfolio planners, portfolio managers, and business transition people in Toronto. Now, Paul has been around for a long time, like myself. He has an impressive track record in the business, right, Paul? That's what you keep telling me anyway. He began with Thorne Riddell, now KPMG, after earning his business degree from Wilfrid Laurier University. He got his CA designation, transitioned to corporate finance with Bank of Montreal and Corp Finance International. In '87, he co-acquired Retirement Council of Canada that he grew before he sold that back in 2002, and in 2006. I think it says in our marketing materials, driven by his passion for helping high net worth people build, manage, and preserve their wealth. So, Paul, thanks for joining us tonight.
Well, thank you, Bob. A bit of an error there. I think it was forced by my wife to get into the next interview.
Is that right? Yeah. Okay. Yeah. So you're batting clean up here tonight for the Investing for Income Summit. Can you share why? We talked about this. We talked about private debt and equity, why we built the thing in the first place. But why did we want to run the Investing for Income Summit? What's important about it?
Well, I think in short, let's face it, baby boomers are a major Canadian demographic. Roughly age 55 to 75. Some are already in retirement, some just moving into it, kicking and screaming like you and I, Bob. But the reality is there has to be a shift from growth-focused investments to income-focused approaches. And with interest rates low not record low. That happened during COVID, and equity markets truly at historic highs. And we think investors and prioritize capital preservation and ensuring that they have fairly stable income. So, this summit really has been about opportunity to introduce innovative strategies to produce income beyond what people are likely to learn about from their bank. One of the things that really surprised me when we looked at the research recently was that there's over $400 billion of Canadian savings invested in bond funds or ETF equivalent. And over the last 5 years, they have provided whopping 1% return. And to my way of thinking, that's no way to provide income for investors for the long run.
Yeah, your numbers are better than mine. I have them down, let's say, at the last 3 years at less than 0% after you've received the interest income. Yeah. And but on the other hand, everybody worries about fees, Paul, and the fees on that, my calculation said 0.72% was made by the manager, which left the investors not much at the end of the day. So we've talked over the past 3 sessions about some diverse opportunities like music royalties, student accommodation, and then tax. Some of the people who have joined us, I imagine, feel a little bit overwhelmed, especially if you attended all 3. Where should they start, and how can Wealth Stewards guide investors through their options that are available to them, Paul?
Well, I think we recognize that it is complex. And we've been incorporating private investments now for over a decade. And back in my Corp Finance International days at the institutional level, that goes back over 25 years. So when we have experience with these vehicles. We've experience with corporate finance, taxation, and every individual has unique circumstances. I think Mustafa referred to, the fact that some people might have a holding company, other people don't. And we want to make sure that we use the right vehicles for the circumstances that are applicable to that individual. Now, one of the things that we did, and I think it started 8 years ago, is we put together a vehicle called the Stewardship Alternative Income Fund, SAFE for short. And we use that as a vehicle these days as a major replacement for fixed income, replacement to traditional bond funds, ETFs, or even GICs. So there's sort of, you can customize, or you can use a vehicle like SAFE to really ease your way into these alternatives.
Yeah. So SAFE is SAIF, just for people wondering where we got the acronym. Now, you and I work together on SAFE. I know the answer to these questions, but let's talk about how we choose investments for SAFE. What criteria do we use? What kind of research do we do to put this portfolio together, Paul?
Well, we have some key criteria. One of them is clearly making sure that there is non-correlation between different asset classes. Put a different way, that's just avoiding putting all eggs in one basket. Second, we look at returns that have a low volatility and low correlation as well. Then we're looking at different structures that provide for liquidity, because a lot of alternatives traditionally individually don't have great liquidity. So we put something together that gives us good liquidity. Then we look at individual managers, some of which are on this call, that have good track records, and we know who's behind the management, having done due diligence on them as well. We want to focus on strategies that don't have any negative months. Now, there's no perfection in the investment business, so rest assured you will have somebody that dips below that negative as a single strategy. But when they're all put together with about 13 other strategies, we've had no negative months since inception. Very key for many people. The next thing we look at is we want to make sure that we understand the assets that are in each strategy. So we've referred to music royalties, student housing, and so on. We want to make sure that we understand them. that it's not beyond the comprehension of our portfolio managers. We look at tax efficiency. That's more important to some than others. But since this is a replacement for fixed income, it is RRSP eligible as well, or RIF eligible, for those people that need to be placed in that out of taxation way. We look at costs. So one of the beauties of putting a fund of funds together is that scalability allows us to reduce the costs that would normally accrue to an individual retail investor. And then last but not least, we want to make sure that that individual client, that their individual goals have been satisfied. As fiduciaries, we have to make sure that happens all the time.
Mm-hmm. Yeah. Yeah. And it is one of the things that people ask. I get the question all the time. So what's your due diligence process? And my response to that is, well, if you want to watch it, tune into our podcast. You can listen to us interview these people. We figure that if we're going to interview people anyway, we might as well make it available to our investors to listen and get that news firsthand. So risk management, Paul, it's a recurring theme around the summit. How does SAFE help clients minimize risk?
Well, I want to go back to that word diversification. It's really one of the only free lunches when it comes to the investment business. So by the diversification that we built into that, it has a great deal to do with risk management. I alluded to the fact that there's no single investment that is without risk. And yet when you put non-correlated vehicles together, we have had no negative months in total in the fund, even though a single investment might have dipped slightly below the year's starting point. And so what we did is a few years ago, I mean, every time you really have to go back and revisit what you've done previously. And a couple of years ago, we did a real deep dive, and there have been some new strategies that had come onto the market. So we really almost doubled the amount of diversification through different strategies. And we were able to, we believe, reduce the volatility and increase the returns, always looking to get that holy grail.
Yep. So just talk about target returns for SAFE. What somebody who comes into SAFE, who's a GIC investor or a bond fund investor who got tired of, making no money, what are target returns? What are we targeting for investors?
Yeah. So we're targeting a 6 to 8% return. We've been quite satisfied in being able to do that. Weren't able to achieve that throughout some of the low interest rate periods of time in COVID when we hit historical lows, but those are realistic returns going forward. And this should be one of the most conservative parts of people's portfolio.
Yeah. So, as as our listeners have listened to various people talk, we hear Mike and we hear Aly talking about 9 to 12. We're talking 6 to 8, but we also had Will Granley's and some of the people who are in the much more conservative real estate backed investments who are down in the lower numbers. But we want to have that combination of the two to make sure that we do that. So how is SAFE currently allocated, Paul?
Well, on the assumption that we can get Riqueza to show the chart here.
There you go.
Very good. Thank you, Riqueza. People will be able to see that we have a broad range of assets. Now, on the left-hand side is where we have at the top left slice, it's private real estate. So student housing would make some of that up. Some private REITs would fit into that category. Private lending would be things like some of the mortgage funds, or one of the early people that came on the investing for income was really short-term lending of investment grade companies to investment grade companies. And then down on the slice in the bottom on the left-hand side, you'll see private equities. And that's where we would put literally, we think when we own music royalties, that's really an equity of sorts. And there's a variety of things that fit into that slice. So very wide diversification within that. The right-hand side is really the public markets. So I won't get into that for this evening.
Okay. So how do you use SAFE? How do we use SAFE in portfolios, Paul?
Well, it really is it has become a replacement for traditional fixed income, bonds, GICs, and so on. And so in today's low interest rates, and we think going somewhat lower, and inflated equity markets, as I referred to earlier, we think this really fits into the replacement of fixed income, but we know through some of the vehicles like we've talked about tonight, that's going to help us skew that return further up. We're quite happy to have some of those equity types of vehicles in there because they're correlated differently to others that are in the SAFE portfolio.
Yeah, as long as they have low volatility, minimal negative months past our screen there. So yeah, thanks, Paul. I think that helps a lot. Thanks for sharing your expertise, providing a strong close to Investing for Income Summit. Now we're going to turn to the Q&A. Let me open up my my panel a little wider here, and we've got a bit here. Question for Aly. Can you speak to the average asset age in the portfolio versus other private and public REITs as it relates to overall quality?
Absolutely, happy to. So right now, Forum Reef has an average portfolio age of about 4 years. Upon acquisition of a Linevest Student Housing REIT, that will increase to 7 years. However, that is still significantly younger than the average age of other private REITs, which hover around 20 years of age, and 40 years for public REITs. Why is that important, Bob? Mainly because with a younger portfolio, there's less capital required to maintain and sustain those properties, and thus more income can flow to the bottom line for distribution to investors.
Yeah, perfect. So Mike, a question for you is, what are some names in your portfolio, some of the artists that you're highlighting in the portfolio?
Well, what do you listen to?
Yeah.
What do you listen to?
What do you listen to?
Yeah, what do you listen to?
What do I listen to? I listen to John Denver. I listen to Van Morrison. I listen to those kind of
I can get behind that.
I'm a 1970s music guy.
Yeah.
Yeah.
Okay. Yeah. So again, as I reiterated before, I mean, the key here on our end is portfolio diversification, right? So we've done acquisitions across every genre and every age kind of category of music, but everything from heavy metal with Five Finger Death Punch and Disturbed right through to classical violinists with Joshua Bell, and we've done deals with Shawn Mendes, Taylor Swift, John Legend, Lumineers, basically everything in between. So it's a pretty reasonably diversified portfolio.
Yeah, I thought it was interesting that one of your advisors was John Legend's roommate at one stage in his career, right?
That is true. That is true. Yeah.
Yeah.
Not born John Legend.
Not born John Legend.
Yeah. Name change.
Name change. Is that right? I didn't
Yeah.
know. What was John Legend's real name?
I knew you were going to ask me.
Yeah.
Stump me. John Stevens, I think.
John Stevens. So yeah.
Don't quote me, but
yeah. Okay. Just clean energy, clean energy is an area that people are interested in, right? Mustafa, tell us about one of the things that we found interesting about clean energy was the shift from the major energy plants to delivering locally.
Yeah. Absolutely. We think about, the energy demands in the country and with immigration trends, like we just simply can't keep up. And, what I spoke to earlier about, we have feed-in tariff contracts with our solar. These are provincial government contracts. We have 9 years left with these contracts. We have make-whole provisions with these contracts. So if they decide to just cancel it, we get paid till the end of the life. And, truth be told, we're quite excited about life after FIT, life after the contracts, because we think about the energy consumptions for the apartment REIT, for instance. And so, for us, life after FIT is to be that private, to be a utility operator of sorts, to provide, and through virtual net metering, where we can produce electricity here and consume it over here. And really, provide, and also because a lot of companies out there, our tenants within the industrial warehousing sector as well, have these green mandates, multinational companies with certain green mandates. And so if we can provide solar panels and solar clean energy to the industrial sites for these tenants directly, well, we can sort of fulfill those mandates. And so it's really interesting to see where the industry is going to evolve to eventually, where we can start to leverage the synergies within Skyline and within the REITs to engage in these private utility contracts.
Interesting. And Paul, that's the end of the Investing for Income Summit. 3 weeks, 3 Wednesdays over the last 3 weeks. I'll just toss out a question for you, sort of final thought.
Well, look, I'm optimistic about the future. And interestingly enough, we put an event on in our boardroom yesterday. Was what are the implications to the Canadian market as a result of the U.S. election? Okay, lots of opinions around the table. We had a very notable speaker come in, but the reason the reason I'm very optimistic is despite all of the various views and so on, I think when we look at our earnings going to be higher 3 years from now than they are today, are buildings going to be occupied in student housing? Are people going to be listening to streaming music and so on? And we think the answer is a resounding yes. So people can get really concerned about things, but the markets with good diversification can serve people very, very well. And since this is an income summit, I think you can count on some of these income strategies to deliver what you need in the future.
Perfect. Thank you. So as I wrap things up, I'd like to thank everybody once again for being part of the Investing for Income Summit. If you have any questions or need further assistance, you can reach out to us. My contact information, bsimpson@wellstewards.ca, or my direct line, even if you've got a PIN, 905-502-0100. We'd also love to have you join our mailing list or check back regularly for updates. Our next event is Outlook 2025. It's something we've run. I think this is number 4, right, Paul? This is 4. That'll be coming up this year. It's currently in the works. We're putting our speakers together. It's probably the first week of February. Also, please don't forget to follow our podcast, My Private Network. You'll be able to, if you want to get a replay of this, it'll be there in a couple of days, where we'll continue these discussions. It's also available on privatednequity.ca and Apple, Spotify, and all those sort of places. So long 3 weeks. We appreciate everybody who's joined us over that time. Thanks for joining us. Have a great evening and good night.
Good night. Thank you.
Thank you, everyone.
Before making any investment decisions, it's crucial to consult a professional advisor to determine suitability. Full disclaimers are available on privatednequity.ca.